The March 2026 closure of the Strait of Hormuz has halted 20 million barrels of oil, representing 1/5 of global petroleum liquids blocked from market. Financial markets are reacting with direct comparisons to the oil shocks of 1973 and 1979. In both instances, Middle Eastern geopolitical crises throttled supply and caused prices to spike. Those shocks led to a decade of stagflation. Unemployment reached 11%, inflation peaked above 14%, and the stock market lost nearly half its value in real inflation-adjusted terms. Warnings of stagflation 2.0 are currently driving investors to liquidate standard portfolios and shift into physical commodities. The transmission of higher energy costs into transport, food, and broad inflation follows the same path as it did 50 years ago. However, the global economy now operates with structural defenses that change how this shock resolves. Navigating this crisis requires diverging from 1970s assumptions. To protect your capital, we have to examine the actual mechanical realities of the 2026 market. Global energy trade flows start from a different baseline today than they did in the 1970s, when the Western world was entirely dependent on imported oil to function. The United States is now a dominant energy exporter, producing nearly 13 million barrels a day. This transition from a dependent importer to a major producer provides a buffer against Middle Eastern supply disruptions. That insulation does not extend to major economies in Asia and Europe. Countries like Japan, South Korea, and India rely directly on crude and liquefied natural gas, or LNG, flowing through Hormuz. LNG is natural gas cooled to a liquid state for easier shipping and storage. The modern global economy also has lower energy intensity. We generate significantly more economic output per unit of oil consumed today than we did 50 years ago, which limits the ability of a supply shock to paralyze the entire system. Central banks have also shifted their behavior. Unlike the 1970s, modern policymakers are focused on price stability and are willing to keep interest rates restrictive to prevent inflation from anchoring, even at the cost of a technical recession. These structural defenses make a total economic collapse unlikely. Instead, the current pain is concentrated in import-dependent regions and fuel-heavy industrial sectors. While the physical price of oil dominates the news cycle, the risk to your portfolio is accumulating in the architecture of the global derivatives market. The crude oil volatility index has spiked near 83, while the equity VIX remains quiet. This gap creates a liquidity drain. Energy producers facing massive margin calls must raise cash by selling short-term assets, which pulls liquidity out of the broader financial system. This dynamic tightens financial conditions across the market. It effectively acts as an interest rate hike initiated by market mechanics rather than the Federal Reserve. This liquidity drain is the primary cause of sudden sell-offs in assets that appear to have no direct connection to the energy crisis. Immediate gains are concentrating in companies with pricing power. Non-Gulf oil and gas producers are seeing margin expansion as they supply substitute barrels for stranded Middle Eastern crude. Defense contractors and maritime security firms are also seeing high demand. Global navies are mobilizing to protect shipping lanes, which increases sovereign spending on missile defense and surveillance systems. These gains contrast with airlines, transport-heavy retail, and long-duration bonds. These sectors face a combination of weaker consumer demand and rising input costs. Gold is the asset most frequently cited as a hedge in this environment, based on its performance during the 1970s stagflation. However, gold is currently struggling against a strong US dollar and high interest rates. Unlike the 1970s, the current market is pricing in delayed rate cuts, which makes gold a more erratic asset to hold. Effectively navigating this shock requires selecting assets that benefit from substitute energy demand and defense spending, rather than relying on broad commodity plays. This chart maps portfolio adjustments to risk tolerance. For the preservationist, the goal is capital protection, achieved by holding short-duration sovereign paper and defensive consumer staples. The active allocator accepts cyclical risk, moving capital into non-Gulf energy and maritime defense. For this profile, gold acts as foundational insurance, but it is accumulated gradually during price dips rather than bought during sudden spikes. Institutional-level macro optimizers are focusing on geographic arbitrage. They are moving capital to avoid counterparty credit risks in energy-starved regions facing high imported inflation. Safe havens for globally mobile capital now require a specific combination: political neutrality, localized energy security, and a robust legal framework. The United Arab Emirates provides these characteristics. It maintains a strict US dollar peg and financial infrastructure that remains insulated from the supply deficits impacting Europe and Asia. Surviving the 2026 Hormuz shock requires matching your portfolio to the current data. You protect your capital by understanding modern structural resilience, not by reacting to the history of the 1970s.